Welcome to The Explainer. Look, if you follow the financial world at all, you are constantly bombarded with terms like ETFs, mutual funds, and hedge funds. But simply recognizing the words and actually knowing how to leverage them for your own money, those are two completely different things. So today, our goal is super simple. We are untangling the nuances of these complex financial vehicles so that by the time we wrap up, you'll make perfect sense of how these tools actually work.
Okay, let's dive right into our roadmap for today. We're going to cover 1. What is a fund? 2. Index funds. 3. Mutual funds. 4. Hedge funds. 5. ETFs. And finally, 6. Choosing your path.
Section 1. What is a fund? The basic mechanics. Before we get into the weeds with specific products, we absolutely need to understand the underlying mechanics. Imagine for a second that you and your friends want to invest in this massive commercial real estate project. Now, if one person had to fund and manage that whole thing, it would be impossible, right? But if you all pool your money together into one big budget, you can easily buy the asset and then everyone just shares in the overall returns. No single person bears the stress or the cost of managing all that capital alone.
Well, that analogy translates perfectly to the official definition of an investment fund. It is simply a pool of money collected from many different investors to invest in a variety of assets. We're talking stocks, bonds, or real estate. And honestly, the best part? It's entirely managed on your behalf. So instead of you sitting at a computer trying to manage 50 different individual investments yourself, the funds does all the heavy lifting, and you just get to share in the overall financial results.
Section 2. Index funds. Passive and steady.
The crucial philosophy to grasp here is this: don't pick winners, copy the scoreboard. See, an index fund doesn't rely on some manager desperately trying to guess which individual stocks are going to skyrocket. Instead, it just systematically copies an established index. Think of an index like a giant sample group, or a scoreboard that represents a specific slice of the market. The S&P 500, for example, tracks 500 of the biggest, most established companies in the US. If you buy an S&P 500 index fund, you're just buying a tiny proportional slice of all 500 of those companies. There's also the NASDAQ, which tracks major tech giants like Apple and Microsoft, or the Dow, tracking large industrial companies. And because these funds literally just blindly follow the list, we call this passive management.
And here is where it gets really good for your wallet. Because there is no highly paid financial manager actively picking stocks in a passive fund, the fees are incredibly low. Take a look at these numbers. The annual fee, which is known as an expense ratio, typically sits anywhere from a tiny 0.02% to 0.20%. To put that into perspective for you, if you invest $1,000, you might pay just 20 cents to $2 a year in fees. You are essentially just paying for a completely automated system to keep running in the background.
But there's a very specific catch to how you actually buy and sell them. Say you decide to place an order to buy an index fund at 11 a.m. Well, your trade doesn't happen right then. You do not get the 11 a.m. price. Instead, you wait until the market closes, the cutoff time, which is usually at 4 p.m. At the end of the day, the fund calculates the total value of all its assets, subtracts the expenses, and divides by the number of shares. This is called the net asset value, or NAV. Your trade from 11 a.m. is finally executed at that end-of-day NAV price. So you don't have real-time control over the exact price, but for long-term steady investors, this system works perfectly fine.
All right, Section 3, mutual funds, beating the market.
Now, on the surface, these might seem exactly like index funds because they also pool your money, but their underlying philosophy is completely different. Where index funds use passive management to just follow a set list, mutual funds use active management. That means there is an actual professional fund manager, or sometimes a whole team of them, who are actively deciding which stocks or bonds to buy and sell on a daily basis. Their goal isn't just to copy the market, their goal is to beat the market. Now that sounds fantastic in theory, right? I mean, who wouldn't want to beat the benchmark? But the data actually shows us that most actively managed funds do not consistently outperform the broader market over the long term.
And that active effort, it absolutely comes at a premium. Check out this expense ratio. Mutual funds typically charge between 0.5% to 1.5%, and sometimes even higher. You're paying for the salaries, the in-depth research, and the expertise of those active managers at massive firms like Vanguard, Fidelity, or JP Morgan. Now, if you firmly believe in a specific manager's strategy, or say you want heavy exposure to a highly specific sector, a mutual fund might be exactly what you're looking for. But you absolutely have to factor in those higher fees.
Moving on to Section 4, hedge funds, high-risk exclusivity.
Okay, we are now entering the VIP room. This is the realm of high exclusivity, usually strictly reserved for institutional money or highly accredited investors.
And what's really fascinating here is their famous fee model, the 2 and 20. When you invest in a hedge fund, you typically pay a 2% annual management fee on your total investment, literally just for them managing your money. On top of that, the fund takes a massive 20% cut of any profits they make for you. It is an incredibly expensive structure when you compare it to the pennies you're paying for an index fund.
So because they charge such steep fees, hedge funds literally have to justify their existence by chasing absolutely massive returns. And how exactly do they do that? By using highly aggressive strategies. They use short selling, which is essentially betting that a stock is going to go down. They use leverage, which means borrowing money to invest more than they actually have. And they use complex financial contracts called derivatives. These managers have total freedom to make bold, aggressive moves. The result? Well, you get the potential for huge outsized profits for sure, but an equally real potential for devastating losses and extreme volatility.
Section 5. ETFs, the flexible hybrid. Exchange-traded funds, or ETFs, are essentially the perfect hybrid. They brilliantly synthesize the best of both worlds. Like an index fund, an ETF gives you broad diversification, mostly tracking a passive index, which keeps the fees remarkably low, usually somewhere between 0.03% and 0.75%. But here's the real game changer: the trading time. Unlike index or mutual funds, which kind of trap you into waiting for that end-of-day net asset value we talked about, ETFs trade on the stock exchange exactly like a regular individual stock. You can buy or sell an ETF at 10 a.m., noon, or 2 p.m., watching the price update in real time. So you get the low-cost safety net of an index fund combined with the real-time, all-day trading flexibility of a stock.
Section 6. Choosing your investment path. So what does this all mean for you? How do we take this alphabet soup and actually apply it to your wallet? Let's connect the dots and match these funds to their ideal users. If you are an everyday investor seeking low-cost, low-effort, long-term growth, index funds and ETFs are generally the way to go. In fact, legendary investors like Warren Buffett consistently recommend this passive, low-cost route for the vast majority of people. Now, if you want specialized exposure to a niche sector, or you strongly believe a specific active manager has a winning strategy, mutual funds are your tool. And if you happen to be a highly accredited, high-net-worth individual who embraces extreme risk and aggressive tactics in exchange for potentially astronomical returns, well, hedge funds are built for you.
I want to leave you with a crucial question to ponder today. Take a good look at your own portfolio, look at your own risk tolerance, and ask yourself, based on your personal financial goals, are you paying for a strategy you don't actually need? Are you paying high active fees when a low-cost passive ETF would do the exact same job? Understanding what these funds do under the hood is the very first step in taking true control over your financial future. Thank you so much for joining me for this explainer. I hope this brought some serious clarity to your screen and, more importantly, to your wallet. Keep learning, and I'll catch you next time.